Hey guys, Eric here, Mr. Fired Up Wealth. And with all the chaos going on in the markets, I thought it'd be good just to bring a video, kind of give you my take on what's kind of happening and my take on investing long term. And if you see the hair, obviously fear is widespread. We hit two circuit breakers, another 20% down, and this is my scared hair. This is my fear hair. And I joke around. I know that a lot of people are hurting pretty bad right now, and they think it's the end of the world. Trust me, if you saw how much my account's down over the last couple of weeks, you'd probably have a heart attack. And here I am, laughing and smiling. Yes, it does concern me. It makes me, think hard at night and maybe, not sleep quite as well and things like that. But at the end of the day, if you're investing in quality, you're investing in blue chip stocks, you're investing in ETFs, those companies with time are going to rebound. And depending on, how the virus, spreads and how fast we recover, you could see a pretty fast snapback with a lot of the companies. Now, there's certain industries that will be impacted more than others. And, obviously there is some risk there. If you think that we're going to go, way lower and you can't stomach the risk, then, it's your choice if you wanted to sell. Obviously, it would have been better to sell a lot sooner, but nobody saw a bear market coming when we were at the top there. Most people thought it was going to be maybe a 10%, 12% correction, kind of garden variety. And a lot of things kind of happened all at once. Perfect timing, perfect storm. You had the oil on Monday with the oil wars dropping oil down to $27 a barrel. That now you've got, fear within the banks that the banks are going to, have, some of their loans collapse and it's going to cause a credit crisis and things like that. So that's where a lot of this panic is coming. And then, you've got the government, and a lot of people think that the government aren't acting fast enough. You've got the NBA shutting down games, postponing the season, basically to be determined. You've got Tom Hanks, and his wife in Australia with the coronavirus. I mean, it's just been a perfect storm. And, obviously we're at higher valuations for a lot of the stocks too. But at the same time, if you're buying Microsoft at $175, it's the same company at $145 or whatever it's selling at now. And, if someone 2 months ago would have said, hey, I'm going to sell you my Microsoft shares for $145, you probably would have bought them. But what happens is the fear sets in and makes your hair spike up, and basically you can't think straight. You get on social media and you see, panic, everybody, short this, short that, do whatever works best for you. But I want to tell you a story. Back in 2008 and 2009, obviously didn't have nearly as much, money, but I looked at some historic data on the taxable account. And this is just the taxable account. That's the account I'm using for Fired, for the financial independence, retire early with dividends. And this is, before I go on, that's another thing. A lot of these companies are cutting dividends. It's another reason why I don't like to have more than a 3% yield. I like to have a low payout ratio with growth, and I like to have yield. So if you haven't watched a DGIF series, there's a series of 6-7 videos on all the different market sectors that have what I call DGIF, they're total growth stocks that pay a dividend and also have growth. So like a Microsoft, it might only pay a 1.5%, or who knows what the yield is now. That it could be closer to 2%. A lot of these yields are getting higher and higher, but that dividend is safe. At least in the current situation, Microsoft's dividend is safe. So you're going to get that 1.5 or 2% dividend. And chances are that stock's going to bounce back. Same with an Apple, same with, a Visa, same with Nvidia. Those type of stocks are generally going to rebound a lot faster if they've got that growth and if they've got the cash flow. So if you're investing in high risk companies that don't have a lot of cash, so like in the marijuana sector, you have a lot more risk because they only have so much cash, and if they only have a 2-month cash reserve and we go into a deep recession, those companies can go bankrupt. And that's why you're seeing a lot of those stocks go lower, lower, lower. So the high quality, say the broader market is down 25%, some of the high quality might be down, like an Amazon might not be down nearly as much, even though it doesn't pay a dividend, just because, it's a quality company, but it also has catalysts. The fact that people are going to order more from Amazon and stay home. They're potentially doing coronavirus test kits, things like that. But the story I wanted to tell is back in 2008 and 2009, I essentially had, it wasn't a large account at that point, but it still is probably, probably still good size, by most terms, but it wasn't nearly as big, of course, as the account is now. When 2008 and 2009 happened, the broader market was down about 47% over 18 months. That's kind of what happened during the Great Recession. So you had an 18-month period where you lost about 47% from top to bottom on the major indexes, the S&P. And so my account was down probably 55%. I had a lot of growth in there and things like that. And I didn't sell a thing. A lot of my friends, were like, hey, you need to get out now. If you want to time the market, be my guest. If you think it's a good time to sell now and you think we're going to go 500 points lower and you want to retime that entry, that's totally up to you. I mean, depending on the type of account you have, if it's a retirement account, maybe that's easier to do. In a taxable account, there are a lot of things to consider, like, taxes, how it impacts your AGI, your adjusted gross income. So if I just go out, and cash out here, it's not as easy as just cashing out and going back in, especially when you have a large amount of money and a lot of different holdings. And so what I did, though, back in 2008 and 2009 is I basically just doubled down. I invested more. I didn't sell a thing. And, basically at the top, when we were at 3350, that account grew 20x from the end of basically 2009 or sometime in 2009. I think it was August or something. But basically over a 10-year, 10 and a half year type period, it grew 20x. So 20 times larger than it was. Plus it gained back its original. So it lost the 55% or whatever, 52 to 55% in that range. It lost that 50% and gained it back. So back to the original number and then times 20. So the key to that is to continually invest. And as you get older, you make more money, you invest more money. So obviously that's not a 20x return just from static money that's just sitting there. It's a 20x return from not only that money that was sitting there, but also adding every single month over the course of 10 years. And that's what an investor really is. And you think of like a Warren Buffett, he's not selling here and trying to retime the market. He's holding cash and thinking about when a good time is to make a move. A lot of you that follow the channel or in the Facebook group, you remember I actually sold a bunch of stock in late December, early January. And that's because I thought, we were maybe due for a correction. Not like this. I was thinking maybe a 5 or 10% pullback, and I wanted to reposition some assets. Well, it turned out to be good and bad. So I sold Facebook at $200. I sold Alibaba, and those ran up. So Facebook went from 200 to whatever it ended up being at the top, 220, 225, maybe higher than that. I actually haven't looked at the chart, but I know it went a lot higher than 200. Well, now it's way less, $160 or something like that the last time I looked. So, I sold at a good price still, but I didn't catch the top. And then I didn't buy it back, but I bought, I started buying as soon as we hit 5%, and I bought more and more and more. And I'm still buying, but obviously at a certain point you run out of cash. And, could the market go lower from here? Absolutely, it could. Am I buying deals that I think are deals like Boeing at $158 today? And could it go lower? Yeah, it could. But if you remember, back, I did the beginning of the channel, I did top 15 investing rules. If you haven't watched that video, check it out. Number one rule is don't invest money you can't afford to lose. And so the people that are panicking, and trust me, you're panicking, and it's more than likely a much smaller amount than, and there's people that have way bigger accounts than what I have, but I'm still not worried because I believe in the companies I'm invested in, and I don't need to sell them right now. Now, when you get closer to retirement, when you need that money to buy a house next year, that's a different story, and you shouldn't be investing that into high risk, equities that can lose 30% in 2 weeks, like we've seen here. The Dow is down 8%, S&P down 7.5, Nasdaq down 6.92. I mean, the Nasdaq's at 7,400. We were approaching 10,000 on the Nasdaq, and that's the way it goes. And you could always say woulda, coulda, shoulda. That's another rule of the top 50 in investing. No woulda, coulda, shoulda. You could say, well, I should have sold when we were at 33.50 and then bought it back at 25.50. Well, more power to you if you can do that every time. But the best thing to do if you're a long-term investor, especially if you're young, is try not to, first and foremost, take care of yourself and your family. Listen to the CDC, wash your hands, do all the precautions to make sure that not only that you don't get sick, but you don't spread, the virus to other people. And that's most important here. So remember that. I mean, your health is more important than any money that you're ever gonna, make or earn, even though it's difficult psychologically when you lose money on paper. You haven't lost any money until you sold. If you think that company is going to go to zero or never recover, well, then maybe you cut your losses and reposition that money. If you're invested in the S&P 500, if you're invested in blue chip stocks like Microsoft, what are the chances that those aren't going to be a lot higher in a couple of years? Especially if you have a 5-year or 10-year time horizon. What do you think Microsoft will be worth in 10 years, 5-10 years? You think it's going to be $140, or is it going to be $300, maybe more? So that's your decision to make. But try to look at it long term. It's obviously easy to think that everything's coming to an end. If the world's coming to an end, you won't need your account anyway. The world's not going to come to an end, though. We're going to get through this, and more than likely your account's going to bounce back sooner than you think. And it's an opportunity to also add at these lower prices. So do your best to save as much as you can as these prices are low and buy opportunity, because someday you're going to be thankful you did, just like back in 2008 and 2009, and even back in December of 2018, I was buying Microsoft at $97, adding to the position that I had for years where I bought Microsoft in the 20s or whatever. I was buying it back December of 2018 at under $100, and it's holding strong at 140, still 40% higher over 18 months. Those are the kind of companies that I want you guys to be invested in, that I want you to hold, that you are confident you can sleep well knowing, my stock is down, but I want to be adding to that stock, not selling it. Those are the kind of stocks you want to own. And if you don't feel compelled in that way to say, there's no way I'm selling my Microsoft at $145 a share, I want to buy more. If you can't say that about everything in your portfolio, you probably shouldn't have bought it. Do I have a couple of those in my portfolio now? I do. And, even the people that have been doing it for a long time, they'll, look back and say, well, probably shouldn't have bought that one. It was kind of like trying to swing it on, at the highs where people were, euphoric. We went from euphoria to fear overnight. I mean, the VIX is the highest I can remember seeing it. I think it's 65. And until that VIX comes down, we're going to have volatility. Can we go lower? Absolutely. But if you think Boeing is not going to go out of business and you like it at $158, maybe you buy a couple of shares. Maybe you wait for it to go lower. That's totally your call. But wanted to give you my perspective on things. Hopefully this helps a little bit, especially if you're a new investor. Try not to panic too much. If it stresses you out, you can do two things. You can sell, and now you don't have to worry about it anymore. Or you can just try not to focus on it. Try to, if you have some cash, try to find price targets that you're willing to pay. Put in limit orders and just turn off your TV, turn off your app. Don't look at social media. Just walk away from it for a while. That's sometimes the best thing you can do. I actually have not. I've made orders, but I've done it through the app. I haven't logged into my actual, Fidelity Trader Pro. I haven't logged into it since Monday, and I'm not even doing any trades right now. If you want to trade volatility and if you want to short stuff, be my guest. There's opportunity out there, no doubt. I'm waiting right now. Right now, I'm trying to get into my positions, wait until the dust kind of settles. And once it kind of starts to cool down, I'll kind of get back into more of that active trading. But right now, I'm focused on trying to put my money to work for long, because these are, in my eyes, they're great opportunities for us. So thanks for watching. If you haven't subscribed, please do. Bottom right-hand corner. And, check out the Facebook group as well. Go to Facebook, type in Fired Up Wealth. We have a group of about 1,400 people in there. We like to have conversations. But check out the channel, watch some other videos. If you have questions, drop me a question in the comment below. Hit the like button, subscribe, all that good stuff. Take care of yourself. Take care of your family. Try to relax. We'll get through it. Have a great rest of your day. Take care.